China has just executed the boldest move in decades, a maneuver that's going to shake the very foundations of global economic power. And if you're not paying attention to what's happening right now, you're going to wake up one day wondering how we arrived at a completely different world without anyone having explained it to you clearly. What just happened is more important than any election, any political speech, or any headline you've seen in recent months. We're witnessing a seismic shift in the foundations of world economic power. And its effects are going to influence your life, your work, your savings, and your future. China has been selling US Treasury bonds in massive quantities. I know this might sound like boring financial jargon, but let me be absolutely clear. This is an economic earthquake of historic proportions, and you need to understand exactly what this means, because what's coming is going to change the rules of the game for all of us. For over 50 years, ever since Richard Nixon ended the gold standard in 1971, the United States has operated under a system that I and many other critical economists call the exorbitant privilege of the dollar. This isn't a balanced system. It's a system built on a gigantic structural advantage that allows the United States to live far beyond its means, while much of the rest of the world bears the cost. Here's how it works. The United States prints dollars. Those dollars are accepted globally as the world's reserve currency. Every country needs dollars to trade, to buy oil, to protect themselves during crises. And because the world needs dollars, the United States can issue this currency without facing immediate consequences. It's like having a money printing machine in your basement, while all your neighbors agree to accept that money as valid payment. Now imagine that one day your biggest neighbor, the one who has the most successful business, who's been accepting your printed money for decades, suddenly says, "I don't want your money anymore. I'm going to use gold. I'm going to use my own currency. I'm going to trade directly with other neighbors without going through you." That's essentially what China just did, and the implications are truly enormous. And now, before I continue revealing why this is so critical, I need to ask you something important. If this analysis is opening your eyes, hit that subscribe button right now. Leave a like on this video so more people can discover this crucial information, and leave me a comment saying whether you had any idea China was doing this. Your support with a like, subscription, and comment really helps me. I read every single one, and it allows me to release even more videos like this. Please do it right now while you're watching so this video can reach even more people. Thank you. And let's continue, because what comes next is even more impactful. To understand why this matters so much, we need to dig deeper. The current system of the dollar as the world's reserve currency is one of the greatest economic distortions in modern history. It allows the United States, a country that represents less than 5% of the world's population, to consume about 25% of the planet's resources. How is this possible? Because the United States can finance massive trade deficits year after year, decade after decade, simply by issuing more dollars or selling more debt that other countries buy. Think of it this way. If you and I spent more than we earned every month, eventually our credit cards would hit their limit. But the United States has been spending more than it produces for over 40 consecutive years. And instead of facing consequences, the rest of the world continued financing this lifestyle by buying US Treasury bonds. China was historically the largest foreign buyer of these bonds. At its peak, China held more than $1.3 trillion in US Treasury bonds. That's more than the entire GDP of countries like Mexico or Indonesia. In practice, China was lending the United States extremely large amounts of money, and the United States was using that borrowed money to finance military operations in Iraq and Afghanistan, to support tax cuts for the wealthiest, and to bail out large corporations. The obvious question is, why would China do this? Why would they finance their main geopolitical competitor? This is where many analyses fall short. They'll tell you it was mutually beneficial. The United States received cheap financing. China gained access to an enormous market, a seemingly positive cycle. But this explanation hides a crucial power dynamic. China didn't have many real alternatives. When you accumulate dollars, those dollars have to be put somewhere. And for decades, the safest option was US Treasury bonds. It was the only market deep enough to absorb the massive dollar flows that China was generating. However, there was a serious weakness. By holding so much of its reserves in American bonds, China exposed itself enormously to U.S. financial power. If Washington decided to freeze those assets, China could lose more than $1 trillion of its national wealth. If Washington decided to issue massive quantities of new dollars, the real value of China's holdings would decrease. And here's the key point. China watched very carefully what the United States did to Russia after the conflict in Ukraine in 2022. Washington froze approximately $300 billion of Russian central bank reserves. Read that again. The United States, in practice, took control of $300 billion from another country. That was a defining moment in global financial history. It showed that dollar-based assets can be frozen and used as a tool of pressure if a country challenges American interests. Put yourself in the position of strategists in Beijing. You have $800 billion in US Treasury bonds. You know that the United States sees you as its main strategic competitor. The Pentagon has already clearly identified you as its primary challenge. The United States is building military alliances in Asia to limit your influence, placing tariffs on your products, restricting technology, and constantly talking about defending Taiwan militarily. And at the same time, you have $1 trillion in assets that this same country can freeze with an executive order. What would you do? The answer is obvious. You would reduce exposure, diversify, and seek alternatives. And that's exactly what China has been doing, not hastily, but methodically, strategically, and calculatedly. The Treasury Department data shows this trend clearly. China has been selling bonds consistently for years. From more than $1.3 trillion at its peak, it now has less than $800 billion. That's a reduction of more than $500 billion. Half a trillion that's no longer financing the American deficit. And China isn't alone. Japan is also reducing its positions. Saudi Arabia is diversifying its reserves and considering selling oil in yuan. Central banks are buying gold at rates not seen in decades. Russia has reduced almost all its holdings. India is accumulating gold. Brazil is making trade deals in local currencies. The entire system that kept the dollar at the center of global trade is slowly weakening. Now, let me anticipate the argument from defenders of the system. They'll say, this doesn't matter. The United States will always find buyers. The dollar is too big. There's no real alternative. China would hurt itself by selling all its bonds. These arguments sound convincing, but they crumble under scrutiny. First, the claim that there's no alternative. That was true 20 years ago. It's no longer the case. China has systematically built alternatives. It created CIPS, its own international payment system, essentially its version of SWIFT. With CIPS, China can move money internationally without depending on systems that Washington controls. China has also been actively promoting the yuan in international trade. It has currency swap agreements with dozens of countries. It's establishing yuan clearing centers in major cities around the world. And perhaps most importantly, it's backing all this up with gold. China has been one of the world's largest gold buyers for years. It doesn't publish exact numbers, but all estimates suggest it has accumulated thousands of tons. Why gold? Because gold has a property that American bonds don't have. It can't be frozen, it can't be sanctioned, it can't be created at will. It's real, tangible wealth. If tomorrow the United States froze all of China's dollar assets, that gold would still maintain its value. Second, the argument that China would hurt itself by selling its bonds confuses short-term tactics with long-term strategy. Yes, if China dumped all its bonds at once, prices would fall. But that's not what it's doing. It's selling gradually over years, reducing exposure without creating panic. It's the difference between running out of a burning building and evacuating it in an organized manner. You reach the same result, but with much less damage. China can afford to accept some losses if it means avoiding a much larger strategic trap. It's better to accept controlled losses now than to remain completely exposed in the future. And now, if you've made it this far, I know you're really interested. So I'm going to ask you, Subscribe to the channel if you haven't already done so. Leave a like, because this analysis needs to reach more people. And leave me a comment answering whether you think the United States can maintain its economic dominance in the coming decades. I want to know your opinion. Now let's continue, because the biggest problem for the United States isn't just the fact that China is selling bonds. The real problem is that the United States needs buyers more than ever. You see, American budget deficits are enormous, trillions of dollars every year. Interest payments alone on the existing national debt now exceed $600 billion annually. The United States is trapped in a debt cycle. It has to borrow more money each year just to pay interest on what it already owes. And if traditional foreign buyers are reducing their purchases, who buys the bonds? The Federal Reserve. And when a central bank buys government debt, there's a technical term for that: debt monetization. In simple terms, the government is creating money to finance itself. And that's exactly what we saw during the pandemic. The Federal Reserve bought trillions in Treasury bonds, expanded its balance sheet from less than $4 trillion to more than $9 trillion at its peak. That's more than $5 trillion created out of thin air. And what was the result? The highest inflation in 40 years. Food prices rose between 20 and 40%. Gasoline prices skyrocketed. Rental costs soared. Real wages fell. The working class was hit hard, while asset owners got richer because all that money creation pushed asset prices up. When the Fed creates money, it doesn't affect everyone equally. It benefits those who own financial assets. It hurts those who live paycheck to paycheck. So when people ask me why this matters, here's the answer. It creates an impossible mathematical problem for the United States. Either the government cuts spending dramatically, which is politically unrealistic, or the Fed continues creating money to buy debt that nobody else wants. That means more inflation, which means your money buys less, your standard of living falls. There's no easy way out. And let me be clear, this isn't just numbers on a spreadsheet. This is about power. The dollar-based system has been the foundation of American global influence for more than half a century. It allowed the United States to maintain hundreds of military installations overseas, impose financial restrictions on countries, and sustain a defense budget larger than the next 10 countries combined. All of this depends on the special position of the dollar. And if that position weakens, the entire structure of American influence trembles. People say China has its own problems. Its real estate market is under stress. Its population is aging. Its growth is slowing. All of this is true, but the point here isn't that China is perfect or replacing the United States. It's about the world no longer wanting to put all its eggs in the dollar basket. It's about having options. For the first time in 50 years, countries have real options. And they're using those options. Look at the growth of BRICS: Brazil, Russia, India, China, South Africa. These countries now represent a larger slice of the global economy than the G7. They're discussing creating a shared trading currency. They're establishing development banks that compete with Western institutions. Saudi Arabia is talking about joining BRICS. It's considering selling oil in yuan. 10 years ago, this would have been unthinkable. The petrodollar system has been a pillar of dollar strength. If major oil producers start accepting other currencies, that pillar weakens. And it's not just BRICS. Countries are signing bilateral agreements to trade in local currencies. Argentina and Brazil trade in their own currencies. India and Russia in rupees and rubles. China and Saudi Arabia discuss trade in yuan. Each agreement is small, but together they represent an important trend. Central banks show their preferences through their actions. IMF data shows that the dollar's share in global reserves has fallen from more than 70% 2 decades ago to about 58% today. And gold is being accumulated at record levels. Central banks bought more than 1,000 tons of gold last year alone. So the fundamental question is, how do you maintain the special position of the dollar when the world no longer wants to grant it so freely? The options are limited and risky. The United States could accept a multipolar world, where the dollar remains important but is no longer dominant. That would require humility. Based on history, that seems highly unlikely. Or the United States tries to force the world to continue using the dollar through pressure, more sanctions, possibly direct actions to control strategic resources. That's dangerous because it transforms an economic transition into a geopolitical confrontation. Or the United States continues on the current path, creating more money, accumulating more debt, and eventually facing a fiscal crisis. That's the hard landing scenario. Or finally, gradual fragmentation. The global system divides into currency blocks, a dollar block, a yuan block. The world becomes more unstable, more unpredictable. But there's no single dramatic collapse, just a constant erosion of the old order. What China did wasn't an isolated move. It was a signal, a demonstration that they have alternatives, that they're no longer trapped in the dollar system. And that signal is being clearly received around the world. Other countries are watching. They see that China can do this. They see that there's life beyond the dollar. And once that perception takes root, the process feeds back on itself. More countries sell bonds, which pushes interest rates up. That makes it more expensive for the United States to finance its debt, which leads to more money creation, more inflation, less confidence in the dollar, more bond selling. It's a negative feedback cycle. What does this mean for you? It means the world you grew up in is disappearing. If the dollar weakens, imports become more expensive, higher prices for almost everything. If the United States has to pay higher interest on its debt, there's less money left for education, infrastructure, public services. If we enter a fiscal crisis, we could see deep cuts in programs that millions of people depend on. None of this is abstract. None of this is just economic theory. This affects your ability to pay rent, to buy food, to plan your future. And what frustrates me most is that none of this was unpredictable. Critical economists like me have been warning about these contradictions for decades. We were ignored, and now here we are, watching exactly what we warned about unfold. What China did by selling those bonds isn't the end of the story. It's just the beginning of a much deeper transformation of the global economic order. And you need to be prepared for what's coming. The old order is crumbling, and a new world is emerging right before our eyes. Thank you so much for watching all the way to the end. Make sure to subscribe to the channel if you haven't already and leave a like. I'll see you in the next episode.